Hello, and welcome to Hoosier Property Taxes, the Local Impact. My name is Addison Pollock, and I'm the Director of Community Engagement with AARP Indiana. We are hosting this event today because property taxes are critical to the well-being of our communities, but older Hoosiers cannot always afford them. This is especially true when they are experiencing property tax increases on top of other rising monthly expenses like utilities, groceries, and healthcare. During 2025's state legislative session, AARP Indiana was fighting for legislation to keep property taxes affordable at the State House. As a part of our commitment to keeping Hoosiers 50 plus informed and prepared, we want to take time today to walk through some of the impacts and changes you can expect to see as a result of Senate Enrolled Act 1 from last year's legislative session. While this topic can oftentimes feel complex and complicated, we hope that you will find today's program informative and useful as you plan ahead for these changes and how they will impact you on a local level. To kick things off this afternoon, I want to introduce Andy Nielsen, City County Councilor for District 14 and City County Council Assistant Majority Leader, to share some thoughts and insights into the anticipated impacts on our property taxes locally. Now, Councilor Andy Nielsen was elected in November 2023 to represent District 14 on the east side of Indianapolis. As a member of leadership, Nielsen serves as the Assistant Majority Leader and Vice Chair of the Administration and Finance Committee. Councilor Nielsen brings over a decade of public policy, advocacy, and government experience to elected public office. Councilor?
Thank you, Addison. And good afternoon, everyone. Thank you for taking the time to engage and learn more about property taxes and the impact of Senate Enrolled Act 1 in Marion County and potential future changes. As Addison mentioned, I represent District 14 on the east side of Indianapolis, and was elected in 2023. And I've been working diligently and at the forefront of SCA 1 and the impact it has and will continue to have on the fiscal health of our city. To put it in perspective, in the 2026 budget, the city had to find nearly $44 million in associated cuts in order to pass a balanced budget. In a moment, you will hear from our very talented treasurer and her team about property taxes and what to expect on your property tax bill. But I want to take a moment to acknowledge a few things. First, there is no question that rising property taxes have put pressures on low-income homeowners and those living on a fixed income. That is a reality that we cannot ignore. However, as a local legislator focused on budgeting and fiscal management for Indianapolis, I am concerned about what SCA 1 does and does not do. The changes made in state law provide benefits to homeowners, but without providing the targeted relief that those who are struggling to keep up really needed. I think that was a missed opportunity, and I will continue to work with my State House partners on policy solutions that achieve stated goals and outcomes. Because the impact of the property tax cut is being felt here in Indianapolis, which isn't to say that we don't need to continue to innovate and realign our budget to be as efficient as possible. That is my responsibility as an elected official. But we also need to recognize that property taxes are a reliable source of revenue for local governments that are raised to finance basic services like police, fire, emergency medical services, parks, plowing snow, picking up trash, and of course, fixing our roads. Broad-based cuts don't eliminate that responsibility. We have to deliver those basic services. It just shifts how we do that. So the next several years will be challenging to ensure we can keep up and continue building a city of the future. In the meantime, I hope we can find ways to ensure relief makes its way to those who are feeling the pressure so they can stay in their homes. I appreciate the opportunity to address you all this afternoon, and thank you again for your engagement. Thanks, Addison.
All right. Thank you, Councilor Nielsen. Always a pleasure to have you on. Appreciate you joining us this afternoon, and as always, your leadership of the city. The next welcome I have for you this afternoon is AARP Indiana's very own volunteer, Stephanie Reese, team leader for the local work we do right here in Indianapolis, as well as a member of our volunteer executive council. Stephanie, good afternoon, and I'll hand it over to you.
Good afternoon, and thank you, Addison, and thank you, City Council Andy Nielsen, for your comments. Again, my name is Stephanie Reese, and I am a co-leader for the AARP Indiana volunteer team right here in Indianapolis. Older adults, by and large, understand the importance of taxes in general, and specifically property taxes for the reason Addison mentioned, that property taxes are critical in the well-being of our communities. Building on this idea is the reality that many older adults face. Current incomes often fail to keep pace with the rising living costs, especially since most of our high earning years are behind us. For many older adults, escalating expenses, including property taxes, can quickly outstrip limited incomes, creating significant financial strain. There are many Hoosiers who would like to see even more targeted property tax relief. At the same time, they understand that changing property taxes for one group can shift the burden to others. If those changes go too far in any direction, it becomes harder to maintain the shared investment our communities depend on. Regardless of personal perspectives, many older adults face a difficult balance, managing limited funds, maintaining a comfortable quality of life, and worrying that rising taxes, especially property taxes, could force them to give up things they've worked so hard to secure. That's why today's conversation and AARP's focus on this multifaceted issue is so very important. With that in mind, I would like to turn it back over to you, Addison. Thank you.
All right. Thank you, Stephanie. We look forward to hearing more from you later in the program. Now let's move into the meat and potatoes of today's program. What changes can you expect to see from your property taxes going forward? To that end, we have a wonderful lineup of guests and experts for the remainder of today's program to break this down for you in a way that makes sense. Our first guest is Larry DeBoer. Larry is Professor Emeritus of Agricultural Economics at Purdue University. He retired in 2021 after 37 years at Purdue. He's an expert in state and local public policy, particularly in issues related to Indiana property taxation. Thanks for being here, Larry, and please take it away.
Hi, I'm Larry DeBoer, Emeritus Professor of Agricultural Economics. Emeritus means has been or retired. And I'm very pleased to be with you here today to speak about the property tax reform that is ongoing in Indiana. We had some very interesting things happening to the property tax after the pandemic, and the legislature responded in 2025 with a great big property tax reform. I think the third major property tax reform since 1973. So it's going to phase in over the next 5 years out to 2031. So I think it behooves us to take a look at what we can expect, what is scheduled to happen, what impact that might have on local governments, and what impact it might have on homeowners that I know many of you are. So let's take a look now at Indiana property tax reform and see what's likely to happen. First of all, the pandemic and the property tax. Hey, why do we need property tax reform? Well, the pandemic came along and really caused some big changes. And the root of that change was what happened to property values. And we've got good measures of home prices in Indiana. This is the average transactions price of a home in Indiana, and it's the percentage change from year to year. And you see in the double O's in the 2000s, the increase was between about 2.5% and 5% per year. And that's been true in Indiana for a long time, going back into the 90s and the 80s and the 70s. And that's the kind of increase we were used to. Then came the Great Recession in 2007, 8, 9, and home values actually declined for a while, and that was unusual. But after that, they increased at an increasing rate. They accelerated until by the end of the 20-teens, we were seeing increases above 5% per year. Very unusual, unusually high for Indiana. Then came the pandemic, and you see for a couple of years there, we had double-digit increases in home values And even since then, in 25, 24, and 23, we've seen increases above 5%, extraordinary increases in home values. In fact, over that period of time, since 2020, home values on average are 57% higher than they were back in 2020. So if you've been following the home prices in your neighborhood or the selling prices on real estate sites, and you're wondering, when did I move to California? Well, that's what it looks like, isn't it? Prices that we were not used to are what we're seeing in Indiana right now. Well, you know, the property tax is a tax on the value of property, and the value of your property was going up. And so sure enough, the net assessed value of property as valued by the assessors for the property tax, that went up too. Now you see some pretty big bars off to the left there in 2007 and 2009, and that had to do with the Daniels reform, and that's what we were talking about 20 years ago. But starting in the Great Recession, you see that home values actually declined in 1 year and increased very little after that. But then home values began to accelerate. The increases in assessed value, and this is not just home values, but all values of property, increased at more than 5% in 2022. And then the pandemic came, and we saw an increase of almost 50% in 2023, and then extraordinarily large increases in the years after that. One thing that tells you is that our assessing system works. Indiana's assessment standard is called market value in use, which means what the assessors aim to do is to value your home and all other property based on what they think it would sell for if it went out into the market in a free and fair sale for the same use to which it's put now, right? So market value in use is what we say. And so you would expect if the assessment system was working and actual market values went up, that assessed values should go up too, and they did. So our assessment system is working. Now, one thing to know is that there's a 2-year lag between what happens in the economy, what happens to actual selling prices, and what happens to your property taxes. And that's because, well, for example, home values went way up in 2021. Assessors looked back in 2022 for the only data they had, which was data from the past. And so in 2022, the assessed values reflected what happened in 2021 with market values. And then those values in 2022 were the basis of property tax billing in 2023. So the 2021 shock to home values due to the pandemic showed up in your property tax bills in 2023. And that affected your tax bills too, right? And what we see here are the net levy after credits. And so this is both the revenue collected by local governments and the tax bills that people have paid. And you can see the pattern looks pretty much the same as it did with assessed value, and look pretty much the same as it did with home values. We see increasing rate of increase throughout the 20-teens, and then great big increases in the levy in 23, 24, and 25. And the tax levy, that's what we call revenue, the revenue that's actually collected from the property tax. The property tax levy that local governments can set is rather stringently controlled by the state. There is a maximum levy, and the increase each year is controlled by the maximum levy growth quotient, but not the whole levy. The whole levy is not under that maximum, and in particular, debt service and school referendum rates are outside of that maximum, and those were the levies that went way up as a result of the rise in net assessed value. So the increase in assessed value, yes, did cause an increase in taxes and an increase in the revenues that local governments collected. Well, it was at that point that the legislature looked and said, hey, we got to do something about this, and we got the tax reform of 2025. Now, the tax reform it passed in 2025 was in Senate Enrolled Act 1, and that's why we call it SEA 1. And it phases in, as you see, from 2026 to 2031. SEA 1 provisions that kick in this year include the supplemental homestead credit. Now, this is the tax cut you're going to feel this year, right? And it's a 10% cut in your tax bill up to $300. So you calculate the whole tax bill, or the treasurer calculates the whole tax bill, and then they knock 10% off up to $300. So that's a credit that is going to start in 2026 and continue on into the future. We're going to eliminate the 30% floor on new business equipment assessments. Now, that homeowners don't have to be concerned with that, but the 30% floor limits the amount of depreciation that firms can take on their business equipment for property tax purposes. And at the moment, there's a floor of 30%. They can't depreciate more than to 30% of the value of their property. We're going to remove that from here on in. And so by about the year 2030, businesses may begin to see lower taxes as a result of this. We're going to use a 9% capitalization rate on farmland assessments. We assess farmland based on a capitalization formula where you take a measure of farm income and divide it by an interest rate. The interest rate we've been using is 8%, but now we're going to use 9% for a while. And if you increase the denominator of a quotient like that, the value goes down, and that should reduce the value of farmland by about 11%, actually. And then we've changed the calendar on school referendums. Up till now, school referendums where you propose a property tax increase and the voters within the school corporation get to vote on whether to approve it or not. In the past, we've been able to do school referendums in any year, and in the May primary election or in the November general election. From now on, it's only going to take place in November of even-numbered years. So that's November of general elections. That's 2026 is one of those years. And so we're not only going to see the normal number of referendums in November, we're going to see the ones that would have taken place in May, and we'll see the ones that would have taken place in May and November of next year. And so I've heard consultants say there could be 50 or even 100 school referendums on the ballots across the state this November. The maximum we've ever had before is 18, I think. So that's going to be quite a sampling of school referendums. On into the future, next year, we're going to create a $2 million personal property exemption, which means that any firm whose property cost less than $2 million to buy, that is the equipment property, not the land and buildings, just the equipment. If it costs less than $2 million, they don't have to pay property taxes on it. If it costs more than $2 million, then you do have to pay property taxes on it. So that kicks in 2027. In 2029, we're going to completely reform the local income tax system, and that will have a little bit of an effect on property taxes, as I'll show you here in a little bit. By 2031, it will be fully phased in. Now, I think the most important thing that happens as a result of SEA 1, especially for homeowners, is the deductions. And there's three deductions we need to talk about. First of all, the standard deduction. Standard deduction is a fixed $48,000 that is subtracted from the assessed value of the home. So the assessor sets the assessed value, and you subtract $48,000 before you apply the tax rates. Second, as you can see, that one's going to phase out. That's going to be reduced to zero by 2031. So that deduction is going away. The supplemental deduction is 37.5% in 2025 and 40% this year. It's going to go up to 66.7%, or 2/3. And that's a percentage that is subtracted from the value of your, the assessed value of your home after the standard deduction is applied. So both of those things reduce the taxable value of your home. Finally, we're going to introduce an entirely new deduction for rental housing and second homes and farmland. And they've never had a big deduction before, but that's going to phase in. It's going to be 6% this year in 2026, and by 2031, it'll be 33.4%. So that one is phasing in. So one of the main things that SEA 1 does is to increase the deductions on most homeowners and on rental housing and on farmland. So a rather large chunk of the tax base of the property tax is going to see increased deductions, which means less of the value of that property will actually be taxable. Well, let's take a look at what might happen with assessed value and the tax rates. And before we do that, though, let's think of two different ways of looking at tax policy. Right? There's the way that the legislature does it, and it's absolutely appropriate for the legislature to do it this way, and that's to compare the results of their policy to a forecast or estimate of what would have happened had the policy not been changed. Right? So what you're doing is saying, hey, here's what the world would have looked like had we not changed the policy. Here's what the world actually looks like. The difference between the two is what the policy did. Apart from anything else that might have happened anyway, here's what the policy did. And that works as a way to look at the impact of policy. But people, you and me, we don't think that way. Right? We don't compare our tax bill to some alternate universe where a different policy would have been used to determine that tax bill. No, we compare our tax bill this year to what our tax bill was last year. Right? So there's two ways to look at it. You're looking at a comparison of the policy to what would have been, or a comparison of the policy to what was. Let me tell you, it's perfectly possible for something to look like a tax cut when compared to what would have been, and a tax increase when you compare it to what was. So it's important to keep those two straight. And I'll be telling you as we go which point of view I'm using. All right. Now let's take a look at some data. And here's a table of data. Indiana assessments in 2025 if SEA 1 had fully phased in. So what I'm going to do is take the actual data from 2025 and I'm going to ask the question, what would the world have looked like if SEA 1 had been fully in effect in 2025? What would assessed values have looked like? What would the levy have looked like? What would tax rates have looked like? And I'm going to apply it to the 5 categories of property that we usually use here in Indiana. And the first one, as you can see, is homesteads. Now, homesteads have those 2 deductions, the standard deduction and the supplemental deduction. There are a few smaller ones as well. And those 2 together reduce gross assessed value, the value that the assessor puts on your property, to net assessed value, the value that's actually taxed, by about 50%. Cuts it in half. We only tax half of the value of homes in Indiana as of 2025. But we're going to now apply a 2/3 deduction, right? 66.7% is going to be the supplemental deduction by 2031. And if we had applied that, you can see that net assessed value would have been about 34% lower than it actually was in 2025. So homestead net assessed values are going to be down substantially, or would have been down substantially from what they were actually in 2025. What about non-homestead residential and farmland? They're grouped together under that 33.4% deduction. As you can see, in 2025, 95% of rental housing, non-homestead residential, was actually taxed, and 99.7% of farmland was actually taxed. Farmland got hardly anything in deductions. Now they're going to get 33.4%. So this is brand new, and I suspect they're very excited about this. It's going to phase in by 2031, and of course, being a 1/3 deduction is going to reduce the assessed value, or would have reduced the assessed value that is taxable in 2025 by about 1/3. How about business real property? Well, business real property got nothing from SEA 1. As you can see, about 77% of business real property, and this is land and buildings of businesses, about 77% was actually taxed, and the difference are the abatements that we give them to improve, to enhance economic development. That's going to remain the same. They didn't get an additional deduction on their land and buildings, but business personal got that new $2 million exemption. That is, the firms that have less than $2 million in equipment cost, the cost to acquire the equipment, that they won't have to pay. And some estimates have said that about 90% of all businesses won't have to pay personal property taxes anymore. The thing is, though, most of the personal property is owned by really big businesses. Right? It's not your hairdressers and your travel agents that own all the personal property, the computers and the hair dryers and the chairs. No, that's not a lot of personal property. That's less than $2 billion. They won't have to pay on that. Where the personal property is with the big manufacturers and the steel firms and the utilities who have way more than $2 million. And what that means is that even though 90% of all the taxpayers may be exempt, we'll probably only lose a maximum of about 28% off of net assessed value. Now, we can't get the number exactly because the acquisition cost of business equipment, which is what the exemption is about, that's private information and it's not released to the public. We can estimate from assessments, but we don't have the actual data. So the 28%, that's the maximum amount that we're likely to lose from the personal property tax base. Add it up, and what do we get? 26.9%. That is, the tax base, had SEA 1 been fully applied in 2025, the tax base would have been 27% lower than it actually was. Now, what does that mean over time? What does that mean over time? Because after all, gross assessed value is going to continue to increase. There's going to be new construction. There's going to be land changed from lesser uses to more expensive uses. Population is going to increase. And of course, property values are going to rise as well. So all of those things are going to increase gross assessed value. But with a 27% decrease, as you see in this table, what it means is that gross assessed values are going to have to grow by about 3.5% to 4% per year just to keep net assessed value constant. That is, if it grows more slowly than that, net assessed value is actually going to fall from 2025 to 2031. All right, so keep that in mind from what we're about to say next, which is the levy. The levy is the revenue that's collected from the property tax that local governments raise to deliver their services. But the property tax is different from all the other taxes in that we recalculate the tax rate every year. And there's a different tax rate for every unit of government. And across the state, there's more than 2,000 different property tax rates, depending on where you live and at which governments actually serve your service needs. Back in 2025, we raised $12.5 billion. All these numbers here are in millions. $12.5 billion in the levy. And so to calculate the tax rate, what we did was to take the levy and divide it by net assessed value, $524 billion, and express it as dollars per $100 assessed value. So you read that average tax rate there as $2.38 and change per $100 assessed value. Now, if you want to think of it as a percentage, that's fine. You can do that. It's the same thing as a percentage. But if you want to talk to a local official or a legislator or something like that, you want to use the terminology we use, which is $2.38. So that's the tax rate. Now, what happens? Well, now the net assessed value is going to be lower, but we're still going to try to raise the same amount of levy. That's what would have happened had we applied SEA 1 in 2025. The tax rate would have been $3.25, almost $3.26, or the tax rate going up 36.7%. Now, over time, what's going to happen? Well, over time, the levy is going to rise 3, 4, 5% a year, as it always does, to handle inflation and population growth. But assessed value is not going to rise. Net assessed value is not going to change very much because of all the new deductions all the way out to 2031. And so the tax rate is going to go up year after year after year. And as you can see, 36.7% is where we'd end up had we applied it in 2025. Now, $3 turns out to be important under the new system. Let's suppose, and let me show you why, by taking a homestead worth $300,000. And I'm taking that because it makes the arithmetic easy. We have in our Constitution something called the circuit breaker. It's a cap on your property taxes. The cap equals 1% of the gross assessed value. That is the assessor's estimate of what your property is worth. So 1% of $300,000 would be $3,000. You can't pay more than that on a house valued at $300,000. Now, the school referendum rates are outside of this system, so you pay extra for that. But for everything else, the cap is $3,000. Now, if we have a deduction of 66.7%, the deduction amount will be just over $200,000, and the net AV after subtracting that deduction would be just under $100,000. Now, what kind of rate would produce a tax of $3,000 on a net AV of $100,000? Well, it's a $3 rate, a little bit more than $3. So if the rate goes above $3, the tax bill would go up over $3,000, but you can't pay more than $3,000 because of the circuit breaker. The property tax on homeowners is maxed out when the rate goes above $3. If you do that same calculation for residential and farmland, they've got a circuit breaker rate of 2%, but they've got a deduction of 1/3. Arithmetic works out the same. $3 rate. You get a rate above $3, and no more property tax can be raised from landlords, non-residential rental property, or I should say non-homestead rental property, and farmland. And likewise with business, they have no new deduction, but their cap rate is 3%. You go above $3, they don't pay any more property taxes. Now, what did we just say might happen to the tax rate? We just said it might go above $3. This is one of the concerns that local governments have. If a lot of rates go up above $3, you've maxed out the property tax. And will that decrease the amount of revenue that they receive? Could very well be. Now, an awful lot of local governments have hired consultants to try to project forward to see what impact this is going to have. So they're worried about that. They're worried about the supplemental homestead credit, that 10% reduction in your tax bill, which is unfunded. That is, nobody's replacing that revenue. It just goes away. It's part of your tax bill that you're not going to pay. So they're going to lose that revenue. And then think about the schools that have the referendum rates. The referendum rates are fixed. They expected to apply that referendum rate to an ever-increasing net assessed value, which will not happen now. So the referendums are going to raise less revenue than they thought. So all of those things have got local governments concerned about how they're going to deliver services with this new property tax system. Well, let's take a look at your tax bill. Right? Let's take a look at homeowner taxes. And, you know, the information I'm going to show you here, you've got it for your own home. Because every spring, along about the time that tax bills go out, the treasurer, the county treasurer, sends you a TS1 form, which is an 8.5 by 11 page. And you've probably looked at it and said, what is this? It's just chock full of numbers. What it is an explanation of how we go from the gross assessed value of your house, that is the value of your house, all the way down to your tax bill. We can use that information to compare what happened to your taxes, or what happened to the typical tax bill in 2025, what would have happened under the old system by 2031, and what just might happen under SEA 1. So let's take a look at what the tax bill looked like in 2025. And I started with a gross assessed value, that is the value of the home, the selling price of the home, of $234,500, $234,500, which is the average gross assessed value of a home in Indiana in 2025. We subtract off the $48,000 standard deduction, and that gives us $186,500. We subtract off 37.5% of that $186,000, and that's $69,938. And we subtract both those deductions from the gross assessed value, we get a net assessed value, or taxable assessed value, of $116,563. Just about half of the gross assessed value. And we saw that in the actual data, where net assessed value was about 50% of gross assessed value statewide. Then we apply the district tax rate. I've used the average tax rate here at $238. That gives you a gross tax bill of $2,779. But you don't pay that. At least in 59 counties, you've got a LIT credit, and LIT is local income tax. And in those 59 counties, they've got a tax rate, an income tax rate, which raises money, which they then use to buy down the property tax for homeowners and other taxpayers sometimes. And the average credit for those 59 counties is 16%. So that revenue does get replaced, right? The $445, which is 16% of $2,779, that $445 is revenue that you don't pay on your property tax, but gets replaced for local governments from the income tax that is raised. But that leaves your tax bill at $2334. Now we're going to compare it to the tax cap. The tax cap is 1% of $234,500, is $23.45. And as it happens for the average taxpayer, it is just under the cap by $11. So you pay the $2,334, and that is your final tax bill. Now, what would happen if we kept that system and moved forward to 2031? Well, what happens between now and then? Well, recent experience tells us that the value of homes are going to keep going up. The gross assessed value is going to rise. I picked a 5% annual increase. Will it be 5%? Well, that's kind of what it was for the few years right before COVID. So maybe, right? But we need a number, so we'll take 5%. It's at least plausible. We subtract the 48, we subtract the supplemental, and we end up with a taxable net assessed value of $166,408. Notice that's a little more than half of the 314. The reason why it's more than half is that the homestead standard didn't increase, right? It's now a smaller percentage of the value of the home. Use the same district tax rate of 238. Tax rates have been relatively stable over the last several years. It's assessed value that's going up, not the tax rates. That's why your tax bill has risen. So we'll use the same district tax rate. It's easy to do. And we'll see that the gross tax bill is $39.67. Lit credit of 16% subtracts $635, and that gives you a really beautiful number, $3,333. We compare that to the tax cap, and we find, oh boy, 1% of 314 up top is $3,143. The tax bill after lit credits is higher than your tax cap, and so you get a tax cap credit of $190. That is revenue that you do not have to, that is tax bill you do not have to pay, and revenue that the local governments do not receive. So that's a revenue loss for local governments. That brings the tax bill down to $31.43. Now, what's actually going to happen, right? That's what would have happened had the old system remained in effect. What's going to happen with SEA 1? Well, nothing different happens to gross assessed value. It just increases 5%. Homestead standard deduction goes away, disappears. It's down to 0. But the supplemental deduction percent goes up to 66.7. The supplemental deduction gets very large, and the net assessed value is $104,646. That's about $62,000 lower than it would have been in 2031, but it's also lower than it was in 2025. Right? It's lower by about $12,000. So think about this from local government's point of view. This big piece of their tax base, homes, going to be declining in value over the next 5 years. So the tax base is going to be shrinking for local governments. What's going to happen to the tax rate? Well, it's going to go up. We said about 37% from the other simulation, so let's use that. That puts it up to $3.12, above $3. The gross tax bill of $3,268. One of the things the local income tax reform is going to do is to eliminate the lit credits. As of 2029, lit credits are gone. So we don't have that. We look at 1% of 314, we get $31.43. That is higher than the tax bill after lit credits by $126. So you get a tax cap credit of that amount. That brings your tax bill down to $31.43. That's the same as it was in 2031, but now we've got the supplemental homestead credit rate of 10% up to $300, and 10% of $31.14 is $314. So you get a $300 reduction. That's $28.43. All right. Is this a tax cut or is it not? Compared to what would have been, it's a tax cut of $300. Compared to what was, the tax bill is $509 higher. Right? It's lower than $31.43 by $300. It's higher than $23.34 by $509. So is this a tax cut or is it not? Yes, it's a tax cut. Actually, compared to what would have happened, yes, it's a tax cut. But what it means is that your taxes are going to go up more slowly than they would have. Now, they might go down in 2026, or you know by now whether they have gone down in 2026. I think a majority of homeowners, maybe a bare majority, but a majority of homeowners will see lower taxes in 2026 than they saw in 2025 because of the supplemental homestead credit rate, which kicks in all at once in 2026. After that, though, we're likely to see continued increases because of rising gross assessed values and the rising district tax rate. That's for the average homeowner, and I think for most homeowners will look like that. But what about lower valued homes in rural areas? Let's have a home that starts out at $80,000 in 2025. And I can hear you folks in urban areas and suburban areas saying, $80,000, where are their homes valued at $80,000? I'll tell you where. In rural Indiana, that's where. In Jay County, for example, which is a rural county, Portland, Indiana is the county seat. It's northeast of Muncie on the Ohio border. In Jay County, about a third of all the homes are valued at $80,000 or less. So this is important in rural Indiana. And if we're talking about taxes outside of cities and towns, we're talking about low tax rates like a $2 rate here. Look what has happened to gross assessed value to net assessed value. Under the old system, net assessed value was reduced by 3/4 because $48,000 is a big part of $80,000, a 3/4 reduction. But what happens in 2031? It's only a 2/3 reduction. And so the assessed value is $35,700, way bigger than it was in 2025. Remember, for the average homeowner, the net assessed value was actually lower in 2031 than it was in 2025. For the lower valued homes, it's higher. When we come down to the net tax bill after making all the other changes, all the other calculations, what do we see? We see a tax bill of $842, which is higher than it was and higher than it would have been. So for lower value homes, this is not a tax cut under any definition. Well, that's an idea about what happens to the homeowners. And you've seen I've clicked through a couple of extra slides. If you take a look at the AARP Indiana website, you can find everything I clicked through, which has summaries of everything I've said. Each slide has a description on it of what I said about that slide. Let me give a little plug for some papers I have written for the Indiana Fiscal Policy Institute, indianafiscal.org. Under news and publications, you can find them. In 2024, I wrote a history of property tax policy over the last 50 years and an explanation of what COVID did to our property tax. And then just last fall, put out a paper about this property tax reform here in 2025. If you're really interested in this sort of thing, there is a lot more information there than I can talk to you about in the time we've had together here. So thank you very much for listening, and thank you to AARP Indiana for giving me the opportunity to talk to you about Indiana property tax reform. I'm Larry DeBoer from Agricultural Economics, retired, Purdue University. Thanks very much.
Okay, wonderful. Thank you so much, Larry, for the presentation. It's very helpful to have a better understanding of how we got to this current point. But now we want to build on that foundation with our next guests. I want to invite Jamie Bolser and Campbell Ricci on to share with us. Campbell Ricci serves as the Policy and Financial Resources Director for Accelerate Indiana Municipalities, known as AIM, where he serves on the legislative team and provides technical assistance to the membership. He joined AIM in the fall of 2019. Prior to working at AIM, Campbell worked at the Indiana Senate as Deputy Policy Director. And Jamie Bolser serves as the Director of Government Affairs with the Association of Indiana Counties. She has more than 25 years of diverse local government experience, both in elected and appointed leadership roles, including overseeing the budgets of all Indiana local government units while serving as Budget Director and later as Deputy Commissioner and Chief of Staff at the Indiana Department of Local Government Finance. All right. Thanks so much for joining us, Jamie and Campbell.
Thank you for having both of us.
Thanks, guys.
Well, I'm going to start in here. Our brief agenda for the day will be to take a look at the property tax reform, and then Campbell's going to later weigh in on the income tax. So if we can advance that slide deck just a little bit. So now next, and jumping in, and I won't spend too much time on the first couple of slides, knowing that Dr. DeBoer touched on some of this information during his presentation. But Senate Enrolled Act 1 of the 2025 session did sunset certain deductions. That list is shown here on your screen. So if you've previously qualified for any of these deductions, they were removed and sunset for taxes due this year. And moving next. Senate Enrolled Act 1 also phased out, as he mentioned, phased out the homestead standard deduction. The homestead as a flat deduction amount was more beneficial to the lower assessed value home since it accounted for a higher percentage of the overall gross assessed value of the property. However, as a flat amount, the deduction did not keep up with the assessed value increases that resulted from the market growth in home values. Moving forward, Senate Enrolled Act 1 and House Enrolled Act 1210 from this 2026 session converted deductions to credits and created certain additional credits. Beginning with property tax due and payable this year, the over 65 credit was created. It's $150. It was previously a $14,000 deduction. The blind disabled credit is now $125, which was previously a $12,480 deduction. The supplemental homestead credit, which is a new credit for any properties that qualify for the homestead deduction, is $300, but it's important to also note that that maxes out at 10% or $300, the maximum between those two. Beginning with property taxes due and payable in 2027, the disabled veteran deductions did receive some modification. Those also shifted in large part from deductions to credits. If a veteran has a VA service-connected disability rating of 100%, they will now receive, beginning next year, a 100% deduction. For veterans that are totally disabled or a veteran of at least 62 of age with a disability of 10% or more, previously qualified for a $14,000 deduction and will now receive instead a $250 credit. So think of those deduction amounts as assessed value reductions, and then the credits are now a dollar for dollar amount. The veterans with service-connected disability and wartime service previously qualified for a $24,960 deduction will now see a $350 credit, and those credits do now also stack, so they can qualify for both the $250 and the $350. Any deduction or exemption that is applied to a property results in a shift of the overall tax burden countywide, with the General Assembly converting the over 65 deduction, the blind disabled deduction, and the veterans deductions to credits that will no longer shift those burdens to the other property types, but results in a dollar for dollar savings for the taxpayers. The units will then proportionally lose a percentage of each credit that is applied. If you are over 65, you will want to look at your informational tax statement that you received in mid-April, more than likely, to see if you have that over 65 credit. If you do not have that over 65 credit and are over the age of 65, you will want to make sure to see if you qualify. Many of the previous restrictions were largely removed. For example, income limits were raised from $30,000 for an individual filer to $60,000, and from $40,000 for joint filers to $70,000. And the assessed value limitation of $240,000 was removed. So if you did not previously qualify, you may qualify now, and that is a substantial savings. Moving to the next slide. Again, this is a slide that Dr. DeBoer did touch on, and it is showing that there's a phase in or an increase to the homestead supplemental deduction. With the phase out of the homestead standard deduction, which is a flat amount, and the phase in of the supplemental homestead deduction as a percentage of the gross assessed value, the deduction will now keep up with any AV increases. While the supplemental homestead deduction removes the same percentage of the tax liability of the gross assessed value for each property, regardless of the value, it does have a higher rate of impact on the overall tax liability for higher valued homes than the lower valued homes. And Dr. DeBoer did a great job of explaining that. However, all homesteads will see a lower overall tax burden as the space is in than they currently receive. And moving to the next. Here's an example that shows the impact for a taxpayer using an overall average assessed value. In this example, the taxpayer also qualifies for the over 65 deduction for last year, which means they automatically would get that converted to a credit for this year. With that said, we do know assessed values are increasing, but I wanted to show the result with stable AV and stable tax rates to show without any other changes, how would that tax bill be calculated? The difference would be a savings in this case. However, we do know that the assessed value changes year over year, and depending on what the overall tax rate is with your underlying taxing units, that will be able to help reflect whether, as a taxpayer, you would see a savings, because as you can see in this example does show a tax savings due to the tax cap. The lower that tax rate, this tax rate in this example is $2.45. The lower that tax rate, the further away you are from hitting the property tax cap, which is good because you're not having a result of a higher tax burden or tax bill. However, it does mean that you have room to still grow year over year. Moving to the next slide, Senate Enrolled Act 1 also created and phases in an increase to the 2% circuit breaker deduction. Well, what in the world is the 2% circuit breaker deduction? That is a way to basically just say properties that are assessed in that 2% category, which are agricultural land, non-homestead residential, and apartment buildings, will now begin to see a phase-in deduction. Again, don't forget those deductions help shift the overall burden, where the credit is a dollar for dollar savings to the taxpayer. Moving to the next slide, Dr. DeBoer did a great job of talking about the business personal property. So what I will say on this slide is, again, this is treated as a deduction or exemption. Deductions and exemptions shift the overall burden within other types of property. So depending on the county's tax base and makeup, depending if they have a higher level of lower assessed personal property, it could cause a shift somewhat to other property types, even homeowners. Here is the order of operations to calculate a property tax bill. You can see beginning at line 5, the direct credits to taxpayers are also, they equate to a direct loss to the local units of government. Moving forward, House Enrolled Act 1499 of the 2023 session and Senate Enrolled Act 1 of the 2025 session impacted the maximum levy growth quotient. It's also referred to as the MLGQ. What that is it indicates the year-over-year growth that an individual unit of government can increase their levy or revenue that's collected off of their property tax bill. So you can see that the MLGQ could not exceed 1.04 for pay 24, pay 25, and pay 26 of this year. Those otherwise you would have otherwise seen higher revenue collections from property taxes. In pay 24, it would have been 1.05, 1.055 for 25, and 1.06 for 26. Right now, it's being estimated between a 5.7% increase or a 6% increase for pay 27. So just keep that in mind. And a lot of the estimates that Dr. DeBoer did run, it was assumed that the levy increases would increase next year. Here's a slide that will show that there are many elements that impact the overall tax bill. The tax rate is calculated by taking the unit's certified levy, or how much property taxes they have requested to collect. It is then divided by the certified net assessed value, which is all of the net assessed values in a unit or a taxing district combined. For example, with AVs growing at a higher rate than the levies, the tax rate should actually decrease. The higher the CNAV, the lower the tax rate. Lower levies, lower tax rate. So there's just a lot of interplay between levies and assessed values that do impact that final tax rate, which is then applied to all of the tax bills. Debt issuance is a common reason why tax rates could grow even if the total assessed values outpace the levies. Remember, higher assessed value growth and not as high levy growth should result in actually a lower tax rate. However, if more debt is being issued, that is a reason why that rate could outpace. As you can see from this slide, 88.58% of all debt issued statewide using property taxes as backing is issued by schools. Cities and towns account for 4.76 and counties 2.38. Looking at the year-over-year comparison in the table to the right, for taxes paid in 2025 compared to taxes paid in 2026, schools increased the amount of total debt an additional $171.8 million. As a result, the property tax rates would either stay flat or increase rather than potentially declining, which does result in a higher property tax bill coupled with the higher AV. You can also see in the table that conservancy districts, townships, libraries, and special units increase their debt year over year at the highest percentages. Counties and cities and towns decrease their overall reliance on debt, which allowed those rates to decline for those individual unit types. Next, this slide includes those debt levies and rates that depicts the total certified levies, which is determined on a local basis. Counties, as a unit of government, saw the lowest change, with conservancy districts and townships seeing the largest percent increases, with the schools showing the highest amount change from 25 to 26. I do want to mention on the unit type special, it does have an outlier that I would like to identify. Health and Hospital of Marion County had to incorporate a $2.7 million levy that the state in the last biennial budget, that funding was removed for Health and Hospital of Marion County, where previously it had been included. So that is shown in that year over year comparison, but it was due to a special outlying reason. Moving forward to the net levies, this slide now takes those certified levies or gross levies and applies any circuit breaker credits and other credits implemented as a result of Senate Enrolled Act 1 and shows the amounts billed to property owners. On a statewide aggregated basis, each local unit will see increase in funding from 25 to 26. That does not mean, though, that each unit within each type of government will see increases. However, it does mean that the majority are seeing very slight increases. You can see as a result of the debt issued from several slides ago, townships and schools see a higher rate of collection due to the higher rate of debt that was issued. Again, keep in mind the special unit line shown here does include that special caveat for Marion County Health and Hospital. And from there, I'm going to toss it over to Campbell.
All right. Well, thanks, Jamie. We've talked a lot so far about property taxes, and property tax reform was the #1 goal of Senate Bill 1 when they passed in 2025, but also included in that was a reform of the local income tax system. Now, this slide shows sort of how the local income tax system works today. Right now, you have a single county-wide local income tax rate in every single county, and they set that based on expenditure category. So certified shares are for general purpose revenue. And then you have economic development and public safety are special expenditure categories, and those flow through to the underlying units as well. And there are also specific rates only for county government for their specific services, like the correctional rate, the EMS rate, judicial rate, hospital rate, and the jail rate is probably the most common one of those that's out there right now. So the way that those are distributed is by property tax levy for all of the different unit types. And that was the number one reason why they wanted to reform this, is because when you distribute it based on property tax levy, that creates some distortions and incentives for what to set your levy at, especially when you're at the tax caps, because there's also local income tax implications. So they decided to change that structure, move away from levy-based distribution and go toward population-based distribution, and breaking up the rates instead of by expenditure category, breaking them up by local government unit type. So as you can see right now, every single rate is countywide, and most of the rates are distributed, all the certified shares are distributed to all the taxing units except for schools, except in certain counties. All that's going away, so you don't have to worry so much about that anymore. And public safety and economic development go to your cities and towns and your county government. And then those special off the top ones just go to the county government right now. We also have property tax relief rates right now, which Dr. DeBoer talked about. And those rates are no longer going to be in effect in the new local income tax system. So if we move to the next slide, we can talk about what right now, tax rates vary a lot around the state. It can go up to 3.75 total. That's up to 2.5% expenditure rate. That's actual revenue that local governments are receiving, and up to 1.25% for property tax relief. The cap's actually higher in Marion County. You can go up to 4% in Marion County because they put the red lines tax rate under the expenditure rate, so they can go up to 2.75 on their expenditure rate, though they have not maxed it out. And the tax rates vary a lot, mostly based on how much the counties have decided to do property tax relief through the local income tax rates. But like I said, all of those are going away in the new system. Aside from the special purpose rates, those are special legislative rates that carry forward, and most of those are for jails as well, just before the jail lit was allowed by statute. So the new local income tax system is going to be now broken up by unit type. And so you'll have up to 1.2% that the county can raise just for county services, up to 0.4% for fire protection and EMS services. That revenue can go to county government, can go to city and town government, can go to township government or other fire units, just depending on how the county wants to break it up for fire protection services. You can also do up to 0.2% for non-municipal services, and that's for things like townships, libraries, conservancy districts, transit districts, any other special unit that you have. And all three of those together can't exceed 1.7%, and everyone in the county pays the exact same rate for all three of those rates. What can be different depending on where you live is the municipal rate. Larger municipalities are now allowed to adopt their own rate just on their own citizens that they get 100% of the revenue from. That's up to 1.2% rate. And for all the smaller municipalities, the county council adopts that rate on their behalf, and that rate applies to the smaller towns and all the unincorporated areas. Now you may be saying, hey, we live in Marion County here. We don't have unincorporated areas. We have Unigov. That's true. In Marion County, Indianapolis acts as the county unit in this scenario. And the only reason you would have a different municipal tax rate than the rest of this is if you live in one of the excluded cities, like if you live in Southport or Beech Grove or Lawrence or something like that, then that city will be setting that municipal tax rate unless they opt to go with Indianapolis's tax rate. So Indianapolis will control all of those tax rates in the majority of the places that you live. But if you live in one of those excluded cities, the city council for that excluded city may be the one setting that tax rate. No matter where you live in the city, the maximum you can pay is 2.9%. They're just maybe different rates depending on which of those cities you live in, depending on the decisions of their city and councils. And then in every other county in Indiana, the county council is the one making the decision for all the small towns and for those other county-wide rates. And like I said, the smaller, all cities and towns now after House Enrolled Act 1210 have the option to just go under the countywide rate. So in many counties, you will probably see a uniform tax rate going forward in the event that that's what they decide to do. None of this goes into effect until 2029, with the local units adopting those tax rates in 2028. So there's a lot of time between now and then for lots of planning purposes to go ahead for them to figure out what those revenues are. This was sort of put in there as a way for local governments to have a little bit more control over their lit revenue going forward to try to help with those property tax impacts from Senate Bill 1, as well as, just addressing some longstanding things they wanted to address with the local income tax system, including no longer distributing based on levy and giving county governments a tax rate that they could adopt just for themselves without having to shoot it through formulaically to all the underlying units in the county. So I know we're running short on time, so I tried to get through that as quickly as possible. But just know that along with this, we're also seeing lots of new conversations about the new local income tax structure, which will have some property tax impacts, obviously because the property tax relief rates are going away, but also will just be factored in the overall tax burden that you all recognize as citizens going forward to deal with these property tax reforms as well.
All right. Wow. Thank you so much, Jamie and Campbell. That is really great information, incredibly helpful. I now want to introduce our final guest speakers for our event today to provide a brief overview of a residential property owner's tax bill. So I'm going to introduce the Marion County Treasurer, Barbara Lawrence, and Community Outreach Coordinator with the Treasurer's Office, Dr. Cheryl Talley Black. We appreciate you both joining us today, and I'll turn it over to you.
Thank you. I can't hear Barbara. Mickey.
Someone unmute Barbara, please.
How about now?
Yes.
Thank you. Okay, sorry about that. I am Marion County Treasurer Barbara Lawrence, and we are here today. I am joined by my colleague, Dr. Cheryl Talley Black, and what we are going to do is take all of this information that has been provided and show you what it means in terms of an actual property tax bill. So without further ado, I'd like to turn it over to Cheryl to talk through a little bit about what the Treasurer's Office does.
Thank you, Barbara. Understanding property taxes. The Marion County Treasurer's Office plays a vital role in maintaining the financial health and stability of our community. As a custodian of county funds, the Treasurer's Office ensures that property tax revenues are collected, safeguarded, and distributed efficiently to support essential public services. These revenues directly fund our schools, police, and fire departments, infrastructure, libraries, and other community resources that residents rely on every day. Next slide. What homeowners should know. Over 386,000 parcels were billed. 1.8 billion in property taxes collected. We held a $466 million average monthly balance to invest, and over 2.7 billion distributed to 48 government entities. Back to you, Barbara.
Thank you. A big change that everyone has talked about is Senate Enrolled Act 1. It was passed by the Indiana General Assembly and signed by Governor Mike Braun in April of 2025, effective for this year, which is referred to as Pay 2026. It is a sweeping change in property tax billing. The bill changed the formula for homestead and supplemental deductions and modified certain credits and deductions. One thing I want to point out is that there are now deductions and credits. A deduction reduces the assessed value of your home, such as the supplemental or the homestead, and a credit is actually a reduction of your tax liability, which is what the over 65 credit or the new supplemental homestead credit would be. Next slide, please.
Deductions and credits. The homestead and supplemental deduction, over 65 credit, supplemental home credit, homestead credit, over 65 circuit breaker, disabled veterans or surviving spouse deduction, blind or disabled persons credit. To apply for any deduction or credit, go to auditor.indy.gov or call the auditor's office at 317-327-4646. Let's take a look at some of the deductions. The criteria for the homestead and supplemental deduction: own a home and use it as your primary place of residence. Your home and up to 1 acre of land could qualify for homestead deductions on your property tax bill. Now we're going to move over to our over 65 credit. This criteria includes that this $150 tax credit is taken directly off the bill instead of lowering the assessed value. If any of the applicant's joint tenants or tenants in common other than a spouse are not at least the age 65, the credit is reduced. Seniors will have income limits and must apply. Other deductions and credits available include disabled veteran or surviving spouse deduction, blind or disabled persons credit. To apply for deductions or credits, go to auditor.indy.gov or call the auditor's office at 317-327-4646. You see, Indiana is changing how property tax savings work. Instead of offering deductions that lower the value of your home before taxes are calculated, the state is switching many of them to credits, which takes money directly off the bill. To offset this, the supplemental homestead deduction will increase each year, so people will be getting a savings or still be getting a savings just through a different calculation. Think of it like this: one deduction is slowly going away, but another discount is growing to take its place. Next slide. Your bill explained. Now, this bill is for those who live in Marion County in the city of Indianapolis. Your charges may be different depending on the county in which you live. But notice there are 2 coupons for the spring and fall payments. So please note that you will not receive a bill in the fall. The information that is specific to the taxpayer is the county parcel number, the parcel number, the taxing unit name. And know that, once again, this is a 25 payable 2026 bill. The same is used in the fall, on the fall installment remittance coupon. Again, the parcel number, the county parcel number, and the taxing unit. And these numbers are specific to this taxpayer. The third part of this coupon is for the taxpayer to keep for their records. You see, again, the parcel number and county parcel numbers are specific once again for this taxpayer. We have the total amount due, and this part of the installment coupon should be kept for the records for the taxpayer. You see the itemized charges for the spring and the fall, $968.38. There were no tax delinquents, no penalties, no assessments, other assessments, no delinquent other assessment tax or delinquent other assessment penalties. Fees, 0, but the stormwater was $29.70, and that was for the spring, and that is for the fall as well. We have the solid waste at $16 for the spring and $16 for the fall. That gives an amount due $1,014.08 for the spring and for the fall. So what is the stormwater fee? The stormwater fee is the utility fee, not a tax, for handling rainwater runoff and solve flooding problems. For more information, Visit www.indy.gov/stormwater. Even if your home isn't connected to a sewer, the fee for handling rainwater runoff and solving flooding problems. What is a solid waste fee? The fee for trash pickup in the city of Indianapolis is $32 per year or $16 per half, assigned by the Department of Public Works, otherwise known as DPW. Back to you, Barbara.
And I want to just make clear, and previous people have mentioned this, and you can go on to the next slide, please. But this bill represents a specific area of the city of Indianapolis. And as Campbell noted, if you live in the city of Lawrence or Southport or the great town of Speedway, it's going to be a different amount. So each bill is based upon the taxing district in which you live. So I'm going to go through what we call page 2, and this form is known as the TS1. It is regulated and overseen by the Department of Local Government Finance, and they prescribe the format. And what I'm going to do is just run down the information that's included on page 2. And what you will see is the credits and the deductions that have been discussed in sort of broad programmatic tenses you will see them specifically on the bill here. So it begins with a special message to property owners, and then it recounts the information, such as the due dates and everything. And then we get into the meat of your bill, which I'll refer to as the tables. So table 1 is a summary of your taxes, and we are required to present 2 years worth of information so you can see how your bill is trending. You've heard people talk about the circuit breaker. It's 1%, 2%, and 3%. On this particular bill, this is a homestead credit or a homestead. So you will find the assessed value on line 1A, which is for pay 26, $181,900. If this were a 2% circuit breaker, it would be in line 1B, or 3% would be in line 1C. So that is the basis. That is your gross assessed value for your property. And if you move on to line 2, you have the deductions. Line 2 and 2A are the deductions. And all of these deductions are listed in table 5 down on the bottom right-hand corner. But it's typically, for this particular bill, the standard deduction, the homestead, the supplemental. If you have other deductions, such as a veteran's deduction, that would show up in table 5 and also be reflected in line 2A. So item 3, line 3, equals the subtotal of your net assessed value of the property. In this instance, after the deductions, it is $80,340. And then you go into your tax rate, and this tax rate is 2.6932, and that's specifically for this taxing area, which is the city of Indianapolis. So you then have your gross tax liability, which in this instance is $2,163.72. And then you have the credits. And these are, as I mentioned, these are actual reductions in the amount of property tax that you owe. So the first one in 4A is the local property tax credits. And these are local income tax credits that are set in Indianapolis by the City County Council. And then they have minus savings due to property tax caps, which is when you're over your 1% limit. So the 1% of the of your gross assessed value is your property tax limit for the 1%. And then moving on to 4C, if you have the over 465 credit, this is where that credit would appear. Line 4D is savings due to the blind or disabled credit. 4E is minus savings due to the supplemental homestead credit, and that is the new supplemental homestead credit granted under SCA 1, which is a credit of up to $300 or 10% of your value. So that is where that shows up. 4F is any savings due to the over 65 circuit breaker credit. And that is a credit that you can apply for if you're over 65 and meet the guidelines. It would cap at 102% of the previous year's taxes for the current year. So, and then we have minus savings due to the county option homestead relief credit. So those are the credits. And again, many of these, I think actually all of them, Cheryl referenced, you can go to the auditor's office for information on how to apply and what the qualifications are, or you can visit the auditor's website at auditor.indy.gov for all the information, and many of these you can apply online. So moving on to Table 2, this is the property tax cap information. So the property tax cap is in this particular instance is 1% of the gross AV. So it's $1,819. And then other people have referenced the referendum. The referendum for a school district is over and above the 1%. So they add that back in. So in this particular instance, it's $299.67, bringing the maximum tax under the property tax cap to $2,118. And as you can tell, their tax liability is $1,936, which is beneath that amount of the 2,118. So moving on to Table 3, this is a synopsis of all of the taxing districts, the larger taxing districts, and what their tax rate and the tax dollar amount was for pay 25 and pay 26. So there's an easy comparison for a taxpayer who gets this bill. Moving on to Table 4, this is where the specific additional levying authorities are identified. Cheryl mentioned the two that are on this bill. It's the stormwater utility and the solid waste, which are both City of Indianapolis levying authorities that show up on your bill. I've already briefly touched on Table 5. But that is where all of your deductions will show up, which roll into line 2A. And these deductions, like I said, it was the standard homestead deduction, the supplemental deduction. If you get a veteran's deduction or other deductions such as that, they would show up in Table 5. So next slide, please.
Billing information. When are property taxes mailed? Tax bills were mailed in early April. The bill has 2 remittance coupons attached, one for the spring and one for the fall. When are property taxes due? The spring bill payment was due on May the 11th, 2026, and the fall bill payment is due on November the 10th, 2026. You may have paid for the full year using both coupons in May. I did not receive my property tax bill. Well, is the mailing address correct? You may change the address through the assessor's office in writing or on their website, assessor.indy.gov, then scroll to change the mailing address for your property tax bill. Next slide. Tax billing and payment. You can pay in person. Pay your bill in person at the office in the city county building on the 10th floor, room 1001. Or place your payment in the drop box located on the 1st and 10th floor of the city county building. Payments, phones, and online payments. Pay your bill for a fee by calling 317-327-4829 or 1-888-881-8986. Pay your bill online at treasurer.indy.gov. For e-checks, there is a 95-cent fee. For credit and debit cards, there's a 2.5% fee. Mail your payments to the Marion County Treasurer. Post Office Box 6145 is a method. Indianapolis, Indiana 46206. Please use the mailing envelope provided with your bill. To avoid late penalties, payments must be postmarked by the post office, paid at a participating bank, paid by phone, paid in person at the city county building, or paid on the internet on or before the due dates. For questions, please call the Treasurer's Office at 317-327-4444. Next slide. Property tax appeals. The Marion County Assessor processes property assessment appeals in the order they are received. To appeal a property assessment online, use one of the following services. The objective appeal form. File an objective appeal if your assessment includes statistical or processing errors. Deadline to file an appeal is 3 years from the date of the assessment. An example is that you received a bill for 3 bathrooms and you only have 1. Under the subjective appeal form, file an objective appeal for opinion-based errors. Examples include the property condition, market adjustments, or trending factors. Deadline is June 15, 2026 for subjective appeals. You can, next slide.
That wraps up our presentation. I want to thank AARP again for hosting this event. We are honored to participate, and if you have any questions, please feel free to call. I think Cheryl has given you the number, or you can go to treasurer.indy.gov, and all of this information is outlined there.
All right, Treasurer and Dr. Black, thank you both so much for walking us through the ins and outs of a Marion County homeowner property tax bill. Really appreciate it. All right, so thank you. So with all that information under our belts, what's next for you as a property owner? As you've heard from local leaders during today's event, there are still a lot of unknowns exactly how Senate Enrolled Act 1 from 2025 will impact you on a local level. We will continue as AARP to watch how communities take action, as well as monitor changes that may come at the Indiana General Assembly in future legislative sessions. So I now want to shift over to some slides. And in 2025, the General Assembly session, AARP Indiana was successful in working to ensure that our voices were at the table to help older residents stay in their homes as they age, preserving housing affordability and stability. So SEA 1 from 2025 contains language that allows counties to establish a program for qualified individuals to defer between $100 and $500 of their property tax liability annually, up to a total of $10,000. The taxes will be paid back with interest when the home is sold or the estate is settled. AARP Indiana supported this deferral program that offers a balanced approach to the challenge of funding vital community services while providing tax relief to those who need it most. To help state leaders better understand how increasing property taxes impacts older homeowners in Indiana, in December of 2024, we commissioned a poll of Indiana voters age 50 plus who own a home in the state. The findings showed that after seeing steep increases in property taxes over the past several years, older Hoosiers are increasingly worried about financial pressures these taxes are causing and are looking toward state leaders to provide some relief. So to better understand how rising property taxes are affecting older Hoosiers, this commissioned statewide survey of homeowners age 50 and older provided data that helps us advocate for meaningful relief that reflects the real experiences of our members. We surveyed 1,001 registered voters age 50 plus who live in Indiana and own their primary residence. The survey revealed that 84%, as you see on the slide, 84% of older homeowners have seen their property taxes increase in the past 3 years. 2/3 say these increases have impacted their household budgets. This is a clear signal that property taxes are becoming a financial strain. Now, support for property tax relief does cross party lines. Whether Republican, Democrat, or independent, older voters agree. Lowering property taxes should be a priority for lawmakers. There's strong practical solutions as well. Nearly 3/4 of respondents support a new statewide tax credit for older homeowners, and even more support for the option to pay property taxes monthly, making it easier to manage household budgets and the like. This summer, lawmakers on the Fiscal Policy Interim Study Committee will hear a report from the Department of Local Government Finance about county and online payment systems that could let taxpayers pay their property taxes monthly. So property taxes don't exist in a vacuum, as you've heard. Rising costs in areas like home repairs, insurance, transportation, and medical expenses mean that even the small increase in property taxes can tip the balance for older adults. The majority of Hoosiers say that increases could make it hard to afford to stay in their homes. So with all of that, we have arrived at the conclusion of our event. I know that was a lot of information in a very short period of time, but luckily you'll have the recording of this. I want to share several resources that are available, including those on your slide. The Indiana Department of Local Government Finance's Tax Bill Estimator, as well as the Indiana County's Directory for additional information. Now, as you heard from the Treasurer's Office, if you have questions about deductions or relief eligibility, please reach out to your county auditors, as they will be the best point of contact where you live. You can also visit the AARP Foundation website that you see on your screen as well. That's ptaconsumers.aarpfoundation.org, which is a great resource. So now I'd like to invite Stephanie Reese back on the screen to close us out for today and invite you to join AARP Indiana's efforts to advocate for Hoosiers 50 plus. Stephanie.
Yes, one thing that stood out to me throughout today's conversation is that property taxes are much more than just numbers on a bill. Behind every tax statement is a person, it's a family, and often a home filled with years of memories and hard work. For many older adults, the question isn't simply about taxes, it's about maintaining stability and remaining in the communities that they love. At the start of this session, it was mentioned that we will let you know how you can join AARP Indiana in our efforts on this issue, or really any issue that impacts older Hoosiers and their families. The first thing to do is to sign up to receive our advocacy alerts. You can scan the QR code and it will take you directly to where you need to go to sign up. You can also sign up to receive text alerts from us by following the directions that you see on your screen. Lastly, you may have seen our team members in their red shirts at various events around the city, raising awareness about quality of life issues for those age 50 and older within the community. We do invite you to connect with us at our events and to sign up to receive more information at aarp.org/IN. Again, aarp.org/IN. Thank you so much for taking the time to be with us today. As shared before, it was a wealth of information. So feel free to review it again once the recording comes out. Thank you and enjoy the remainder of your day.